Good afternoon and welcome to this event on mergers and acquisitions as part of strategy. My name is Petri Gostowski. I'm an analyst at Inderes. I'll give you a short introduction to today's topic, after which we have two company presentations from Aspo and Relays. If we kick off with looking at the typical acquirers in the stock market, I've divided them into three. I guess a big part of the acquisitions in the stock markets are done by companies that are so-called industrial acquirers. Typically, for these kind of companies, acquisitions are more supporting element in their strategy. They acquire companies to boost their growth, maybe go into new geographical markets. And typically these kind of companies integrate the acquired companies and they seek synergies, typically cost synergies after integrations. Whereas if we look at serial acquirers or compounders, I'd say acquisitions are more a part of these companies' business model, a more essential part for in their value creation model. There are a few different kind of serial acquirers. You can maybe divide them based on if they operate in one industry or multiple industries. This typically also correlates with the size of their business. Then we also have holding companies. I guess they're very different holding companies. How they may differ a lot, but it's common for them to just own numerous companies from different industries. They typically don't seek synergies in these. I guess everyone knows the biggest, one of the biggest and the most known holding company of Berkshire Hathaway. If we look at how companies can create value for their stakeholders with M&A, I think if we start off with shareholders or owners of the company, I think acquisitions provide a very good way to redeploy capital. I've put here with attractive returns. Obviously, this is not always the case. You should not only rely on that. I guess academia finds it that most acquisitions don't create value, so it shouldn't be taken for granted. And actually going into that soon, but investors should always evaluate if acquisitions actually have elements of value creation. Then if we look at the entrepreneurs or the seller in the case of an acquisitions, obviously it is very common that to sell your company to the acquirer, it's an exit opportunity. But also I'd like to highlight that for a small individual company, being part of a bigger company, it gives benefits. It may open doors for new growth opportunities. For a small company, it might be more of a bigger risk to make an investment that as a part of a bigger company is not such a big investment as a whole for the group. Obviously, it is typical more, especially in the smaller end, that once a company grows, a business grows, the entrepreneurs have to actually take more of administrative tasks. And they need to focus less on, or they may focus less on the operational part, which then often is the part that they are more interested in. So it's very common that actually to be acquired it may release time for the people in the company to actually focus more on the operative side of the business and less on the administrative side that is usually taken care of by the new owner. I do believe also that being part of a bigger organization or group may open for the people in the company interesting career development opportunities. As part of a bigger group, it is typically easier to build long-term career development. Next, if we look at the investor side, I've put here three areas of which I tend to look at when evaluating acquisitions or deals. Obviously, I like to start with valuation, although these are not in any specific order here. And I think it's good to bear in mind that when companies actually deploy capital to acquisitions, it's a lot of the part of the capital that they deploy is actually the owner's capital. So it's good to look in how it is deployed, because there's always the opportunity or the possibility to actually pay out the capital to the owners. So it should be benchmarked into towards these kind of opportunities. Therefore, I like to evaluate the return on capital that is expected to earn on this acquisition. Key things that will impact the return on capital is also obviously the capital intensity of the business that is acquired, what kind of cash flow it generates. And if we think about the capital intensity, this is all linked highly to the amount of the capex that the business needs, and typically also to how much it ties actually working capital. Then if we move on from the valuation to the business characteristics of the acquired capital, I think it's very important to understand what are the future prospects of the acquired business. Here, important is actually the market growth or the industry growth where the acquired company operates. Also, I like to put focus on the continuity of demand. I believe it's much easier for the acquirer to understand the business when it has some kind of continuity in demand. The other end of the example would be some project business where typically you have to start the selling process every day or every week again, and then there's a different continuity in the demand. Also, I like to emphasize that if you think about the serial acquirers for them it's also important that the acquired business actually has potential to redeploy capital. So whether it's into organic growth or future M&A. So a business or industry that has a lot of small companies, obviously more or better business area to redeploy capital. Thirdly, I look at the structure of the deals. I believe there is not only one model that fits this area, but it's good to evaluate how the acquirer uses cash and stocks when acquiring companies. Earn-out mechanisms are obviously a good way to make sure that the owners or the sellers are in the same boat, so to say, that the good business performance continues after the acquisition. Lastly, I believe there are some very key areas where to watch if one is interested in the long-term performance of companies that tend to acquire businesses. I'd like to emphasize the importance of the business performance. So you should not forget to evaluate the business after the acquisitions. Much more happens actually after the acquisition. So it's very important to understand and follow the development of the acquired company and what kind of return on capital the business earns, because this will eventually be reflected into the company's figures. Like I said, if a company is a serial acquirer, it typically does multiple acquisitions, then it's very important that these acquisitions are successful. And in the long term, if you aim to grow through multiple acquisitions, you will need to scale your M&A functions. It is very common that companies tell that after acquisitions that they've tied a lot of time and management time on an acquisition. So if companies do a lot of deals, eventually they won't be able to bring up the speed if they don't scale their M&A functions. Thirdly, I'd like to emphasize incentives. Thinking about long-term performance, you usually get what you measure, so it's very important to actually tie incentives into long-term performance instead of short-term. So, for example, tying incentives into long-term return on capital instead of some absolute earnings figure, for example, for next 1 or 3 years. So, and this was my short introduction into the topic, and next I'd like to invite Aspo to the stage.